Welcome back to the channel. Before I get into the topic, I wanted to clarify a point that might mislead some viewers. I'm talking about long-term bonds with respect to their duration. Something like a 20 or a 30-year bond. I'm not saying that bonds are a bad investment in the long term. In fact, long-term and short-term bonds can be a great investment in the long term. Just clarifying that so that there isn't any misunderstanding there. Right, so let's quickly go over what a bond is and what are the important factors to consider. A bond is just a debt instrument. When you buy a bond, you are loaning money to some counterparty. The counterparty will then pay you interest and eventually will return the principal that you had given them at the maturity date of the bond. When looking at bonds, there are three factors to consider. The first is the price of the bond. Second is the coupon or the interest paid out. Third is the duration of the bond. For this example, I'm just going to focus on government bonds here. So the assumption is that they are the highest rated, best quality bonds that are never expected to default. As investors, what we can do is assign probabilities to future outcomes and invest based on our best judgment. Presently, we are in a scenario where interest rates are pretty much at zero. Historically, interest rates have been at around 5% or so. The question for someone who is planning on investing in bonds today is, do I think that there's a higher probability of interest rates being lower or higher in the future? As interest rates rise, bond prices fall. As interest rates fall, bond prices rise. This happens due to the interest payments being discounted at higher or lower rates. Let's take an example of a 1-month bond and a 1-year bond. The investor is loaning their money to some counterparty for 1 month in the first scenario and for 1 year in the second scenario. I think that you would agree with me that the probability that something really drastic happens in 1 month is much less than something drastic happening over 1 year, right? So the coupon or the interest rate of the 1-year bond should be higher than the 1-month bond because you are taking on more risk. This is precisely why the longer the duration of the bond, the higher the risk and the higher the interest rate. The investor is receiving a higher interest rate on long-term bonds as there's a lot more risk because of the duration of the bond. A small change in the interest rate will affect long-term bond prices a lot more than short-term bonds because it affects 20 plus years of interest payments as opposed to just 1 month of interest payments. I'll illustrate this with 2 bond ETFs that will give you a very clear picture of the impact with respect to duration. The first is TLT, which is made up of 20-year plus treasury bonds, so long-term bonds. The second is SHV, that holds bonds maturing in less than 1 year. The average maturity here is just a few months. Before we even get into the graphs, try to think for yourself and answer these 2 questions. If you can answer these 2 questions, you have gotten a better understanding of bonds. The first question is, which will give me a higher yield, TLT or SHV? The second, which will have more price volatility, TLT or SHV? If your answer for both these questions is TLT, then good job. You have a better understanding of bonds. So since 2009, we have had very low interest rates all the way till 2016. And here we can see how the TLT price movements would have given us a capital gain of 50% in that time period. The capital gain is on top of the interest payments that the investor would have received. Then from 2016 to 2019, as interest rates kept increasing, the TLT ETF, which is focused on long-term bonds, fell quite a bit and went nowhere until we saw that interest rates went back to zero during this lockdown period. Now let's take a look at SHV, the short-term bond ETF, and how it has fared during that same time period. Since 2008 till today, the price fluctuation is less than 1%. The ETF is just paying out 1 to 1.5% in interest throughout this entire period. Now, the reason that most investors have bonds in their portfolio is to increase the stability of their returns and generate a stable fixed income. TLT is a really good ETF if someone is looking for short-term capital gains on bonds, basically trading bonds. But this is not an activity for most investors, and most likely people are going to lose money here. Being invested in short-term bonds makes a lot more sense if someone is looking for a more stable place to invest cash and generate a yield for the long term. If you are confused about this topic, I can completely understand. You can always share your doubts in the comments below. It is not an easy topic to understand, but once the idea clicks, it will change your perspective about investing as a whole. So do share your thoughts and doubts in the comments below and try to get a understanding of this topic. Thanks for watching this video and have a great day.